And good morning. Happy Wednesday to everybody. It's Breakfast Club with Jeff and John because you have nothing better to do this morning. So thanks for joining us. Glad to have you along with us. Let's get underway. We've got some stuff to share. Certainly a big day in the markets yesterday. Um, um, the headline on the CPI was worse than some of the numbers. Um, but at the end of the day, what it meant was that the market believes the Federal Reserve has all the juice it needs to cut rates in September. And I don't know, we've got about 4 weeks, 4 or 5 weeks until that meeting. So we'll see what happens. Thing to watch coming up later this month is the Jackson Hole Conference. We'll see if Jerome Powell gives anything away. I would bet that he doesn't because he never does. But yesterday's action, the Russell led the way with a massive rally. Small caps expected to outperform if the Fed reverts to a rate cutting cycle. So uh, the small caps have largely been down most of this year as the Fed was in the higher for longer uh, phase. So if the Fed is shifting to more dovish and rate cutting uh, at upcoming meetings, then you should absolutely keep small caps on your radar screen more often than not for stock trades or stock investments. Excuse me, a little less often for options just because of the volume. But that doesn't mean that there aren't small caps or components to the Russell 2000 that you can't trade, or there does mean that there are, whatever, you know what I'm saying. Plenty to choose from. We had another double trade close yesterday on the RUT in the Millionaires Trading Club program. Total gain for the day, $725. We started the day by closing the existing put spread. Uh, I think that closed at 9:58 a.m. For a net of $475, 5 contracts. And then a little bit later in the morning during the live session, we opened the 15 August put spread. No, 12 August yesterday was the expiration. So today being the 13th, we had to close it yesterday, but it wound up hitting our good till canceled. So we immediately put a new trade on with a Friday expiration. That trade lasted all of 4 hours. And so, like I showed back in July when this happened to us, it can happen when the Russell gets on a heater. That the Russell can move and certainly moved rapidly enough for our benefit. So we wound up hitting our GTC, our good till canceled GTC order yesterday, a little after the 3 o'clock hour for another $250 gain. So nice big day for Millionaires Trading Club members. We'll recap that again next week, and we'll take a fuller look at how we've been doing with the trading the Russell 2000 over the last 7 weeks. So very strong performance. Even a trade that was challenged wound up working out just fine. So again, reminder here, this is the last big data week for the month of August until we get down toward Labor Day. Retail sales Friday, that'll give us a better view of what's happening at the consumer level. I will note, and we'll go into a couple of stocks here. There was an important stock that beat earnings, but their forward guidance was substantially lower. And it is a stock that we have traded with you in the past regularly as part of the Income Masters program. I don't believe we have a position in it right now, nor have we been trading it for some time. But we'll take a look at that stock. So because and we'll do a little bit more on that side because there are still buts in this market. Yes, buts. Yes, the market is higher, but so market's trending higher pre-market, building on yesterday's record closes. And certainly we should call this and acknowledge that this is a rate cut rally, but we need to take a look at a few things. So let's hop off to FinViz for a second and give me just a second to get the menu working. To get the menu working. Thank you. There we go. So switch over to FinViz here. And the first one that I want to look at is some of you may have remembered this company, Kava Group. It's a fast casual restaurant group. If we go back and look at a weekly chart, you see it had a huge run up in its early stages in 2023 through 2024. Not so much in 2025. Stock pre-market down 24% as the company reduced forward guidance. They reported earnings yesterday. After the market closed, we could see those down here in the lower right corner. Revenue missing by 2%, and that led to the forward guidance being lower. This is a middle class type restaurant. Uh, and when I take a look at how some of these types of companies are performing in the consumer cyclical sector, and I'm going to look at restaurants. Right. So right now I'm just looking at these. I am just going to look at U.S. restaurants. I don't give a rat's patootie about restaurants in Brazil or China or France. So let's start with that. So we just have three basic metrics here. I do like a volume of it, 200, at least 200,000 shares. So, you're looking at a stock that's at least tradable. Next up, I want to look at companies that have profitable earnings, right? Their earnings EPS is above zero now and into the future. So nothing fancy, no crazy scanning stuff needed here. And the universe that meet those criteria, 24 companies. But one of the things that I tend to look at is over here, it's called stats. And this gives me a really nice view of performance of this group of stocks versus the S&P 500 as shown by the SPY. And this category of stocks, the gold and light blue lines here are underperforming the S&P, not badly. They're positive for the year. But if we scroll down and we look at the very bottom down in this section here, you see very uneven performance. Negative for the month, the quarter, for the half year. They're positive over 12 months by 10%. But year to date, negative as a group. So the importance of this and what this tells me is there may be some stocks in this group that are performing well, but there are a lot of stocks that are not. So if we take a look at how are they doing, we can take a look at the quarterly performance on the positive side. Best company right now, Potbelly. Good sandwiches if you've ever had Potbelly. Up 27%. Wingstop. I think we've actually talked about Wingstop in the past. They're doing well, up 20% for the quarter, but down 7% for the year versus Potbelly up 87%. So there are some stocks that are doing well, but that list is pretty short and on the quarter side, and the vast majority or the majority are negative for the quarter.
The interesting thing, if I can jump in about Potbelly too, is part of the reason that they're going up is they're actually closing stores to get rid of expenses.
Yep.
So,
And you I'm sure you'll talk about it. Your little side sojourn yesterday. I mean, that's the cutting expenses to increase earnings. You can only do so much until you run out of opportunity there. So there are a couple of other areas that I was looking at. By the way, everybody knows Domino's Pizza. We've traded that one successfully in the past. Let's see, what was I looking for? Shake Shack was a hot name, not now. Yum Brands, very well known, underperforming. So remember, I said yes, but this is the but. This is one of the categories that is the first to be cut or reduced by consumers in spending. Restaurants eating out, especially you start looking at higher, not, I don't want to say higher, it's like that middle tier of restaurants like a Cava. Even Chipotle has been performing well. I'm not sure if they're on my list here. There they are. Chipotle, not so hot anymore. That's after, I'm sure, multiple splits, but that stock is now down 20% in the month, excuse me, year to date, 30% almost for the year. So this is an important category to watch, regardless of how retail sales come out later this week. This is where I would be avoiding these stocks if I were trading them for options, unless you're playing a short or bear call spreads. You might look for bear call spreads in this category. because the charts tell you some of these can certainly perform that way. McDonald's is up, but still large, but down for the year. So there's certainly some opportunities. Wingstop, crazy chart. Gap up, massive pullback, rising again, post earnings. Hey, pays a dividend. How about that? You can get wings in a dividend. So this again is the consumer cyclical category, and the industry is restaurants. This is just it is a way to get a snapshot of what's actually kind of taking place post earnings reports for this group. And again, over the 12-month period, outperforming the S&P 500, but not so much this year. Another one on sort of the opposite side of the spectrum that I wanted to look at was a company called Chef. Stock symbol is literally CHEF, Chef's Warehouse. A little bit of a different story here. And this is still a consumer, this is a consumer defensive in food distribution. But what's unique about this company is they supply to high-end restaurants. So although the middle to maybe upper middle may be cutting, and certainly lower economic strata cutting expenses on the eating out category, this is likely not a category that will be as dramatically affected. This is a company that I actually, it was either in the January or the February three stock report earlier this year. I gave it as an alternative. Probably should have made it the primary pick. In that time period, you could see the stock moving from roughly the 50 to $65 a share in a month and a half before all the tariff mess kind of pulled it back in. Um, but has largely held its 200-day moving average. It's trading at a little bit of a premium for forward earnings. For a consumer defensive stock, 18% EPS over the next 5 years, down here in the middle of the lower middle of the screen. That's pretty solid to me. Uh, Largely performance, quarter, half year, etc. Far left side over here, far right side, excuse me. All positive. Stock is clearly in a range, so there's a clear top, a clear bottom. They just reported earnings. Excuse me. They beat on EPS. They beat on revenue. So there are metrics here that justify looking at the stock as a potential trade. That was an interesting thing. I didn't know I could do that. That's my mouse. I could do that with my mouse. How about that? Um, and largely holding most of its moving averages. So 50 is acting as pretty solid support and trading around its 20-day moving average. On the daily chart, if you look on a weekly chart, you can see stock is still in an early stage uptrend, or at least in a middle stage uptrend. Yep, it broke down here in the, that's tariff induced, so not not company or revenue or earnings induced. If we look at revenue, we can see revenue is expanding, maybe a little bit slower from 2023 to 2024. We'll see what their 24 to 25 revenue turns out to be. Earnings on the far right, left side, earnings growing. So certainly good reasons to own a company like this, even though it's in a consumer defensive category. Stock doesn't pay a dividend. Boo. They do have options, but if I want to double check, I don't think they were. Yeah, they're thinly traded, so not really an optionable stock. So this would be one where you'd want to be in maybe for a longer period of time. So if you're looking for something to add, a stock you might hold for 6 months, 12 months, this might be a worthwhile stock. I don't know that it's as much a trading stock unless you're day trading, but for a longer term, anything at or above $60 a share is probably a reasonable entry point, and stock has some room to grow. Let's move on to a different sector real quickly. I want to go back to, actually, I know exactly where I'm going, so I'm just going to go right there. A company called Tapestry. Similar to Chef, Tapestry is largely serves the upper third of consumers. They are the owners of the Coach and Kate Spade brands of ladies' handbags. Now, I'm not necessarily in the market for ladies' handbags personally, but Apparently, a lot of other people are. Stock has been on a consistent run since late last year, from 50 to over $100 a share, $110 a share. So the stock has more than doubled in the last 12 months, uh, and still trading at lower right here, 20 times forward earnings. Little less in the long-term growth at 12.5%. But for a retail company, that's still strong. And they have brand recognition. They have fans of their handbags, both Kate Spade and Coach. Little flat right now, and I believe that's going to be earnings tomorrow. Yeah, earnings tomorrow. So 102, 1.68 billion. So we'll see how their earnings turn out. Last time, they were beats across the board. So that's good. They've actually had multiple quarters of beats. Stock does pay small dividend, 1.25% at current prices. So again, a company that I would add to my list. I do believe they trade weekly options. They do. So Jeff, this might be one that we want to take a look at as a potential trade. Um, Not sure how much volume there is, but if there's a little bit, a single trader can certainly execute a trade in here and have an opportunity on either the put or the call side. Uh, but this, again, a company that I've been watching for quite some time. I want stock detail. Thank you. Again, a company that I liked. I liked this company last year, but I just didn't believe in retail heading into the end of the year. So much uncertainty, and I was right about the company, and I was wrong. So I should have just trusted my instinct. It's a lesson to learn. Sometimes you can outthink yourself and outsmart yourself trying to come up with reasons not to make a trade. And that's almost exactly what I did with Tapestry. So a couple of names there for you: Chef, CHEF, Tapestry, TPR. We'll do some more sector analysis in this area. Looking at what else was I looking at? I was looking at internet retail. I was looking at hotels, lodging, airfare or airlines, etc. So we'll keep that going over the next few weeks because we'll really get a better sense of what's taking place in the market and where the opportunities are. Jeff, I know you have things to share, so let's
Sure.
get on to you.
All right. Good morning, everybody. Let's do. I'm going to share a little event. I was talking to John right before I came on the call today. But so I just wanted to kind of start off with a little bit of a macro look on things. So I was invited to a leadership dinner last night. There were some local CEOs, senior VPs, upper managers, in my favorite. There were people there that were called thought leaders, which I'm not sure what marketing team they have, but from now on, I want to be known as a thought leader. I'm like, is your thought the lead? I don't know. Anyway, it was a fascinating thing because it wasn't like, hi, I'm a CEO of, Traders Reserve or whatever. It's like I'm a thought leader. So anyway, fascinating title. So the theme of the night that was essentially how do we cut headcount? No, I'm sorry. What their theme was, how do we reduce expenses by using AI? But when you started talking to everyone, it really kind of came down to how do we cut headcount, and how do we get rid of one of the most expensive parts of running a business, which is the employees. And so they were all talking about using AI to speed up the process to get rid of headcount. I'm not going to mention any names of companies because that would be rude, but they're certainly out there. Anyway, so the goal really, or what the outward facing goal that these people said, was that they really wanted to use AI to increase efficiency of manufacturing products, of marketing products, of some of them were business to business companies, and so they were trying to figure out how they can use AI to create new products, that help a need in the marketplace, whatever. So again, speed to market. In software development, they were saying, hey, we have this idea, we have clients who need this idea, but whether it's developers time, whatever, we need speed, increased speed to market. We need to gain a competitive edge. But another theme that was interesting to me, and maybe it's just the group that I was with or whatever, but a lot of them were talking about fighting tariffs and regaining profit margins lost due to tariffs. And so I started asking a little bit about that. And it's, hey, right now we're trying not to have the tariffs have a major effect on everyone. It's having an effect on our bottom line. So we do, we're either using existing inventories, we're agreeing to slimmer profit margins for now until we figure out what the true impact of tariffs will be. But if it continues this way, we're ultimately going to have to reduce expenses. Um, you know, to bring our profit margin back to where it needs to be. So, of course, my question back to a lot of the people that I was, rubbing elbows with was, hey, who, are going to buy your goods? Let's say the S&P 500 company, all 500 companies in the S&P 500 all decide to cut their workforce by 10%. Who the heck is going to be buying all of your goods? And the answer was essentially, you're looking at the problem all wrong. You're not a CEO. How would you know all this stuff? But no, just kidding. No, they say I'm looking at the problem all wrong, and it is ultimately the AI boom, whether it is creating facilities, energy facilities, whether it is developing AI, whether it is doing all of these, whatever. I mean, you name it. Their idea was all we're doing is changing the workforce from one role to another. However, we're not responsible for training that workforce, so we need to get rid of the workforce that's not helping us. And then, yes, maybe we'll hire or whatever else, which I thought was really interesting. A lot of people, were trying to remain positive, saying, "Oh, we're going to hire people. We're just hiring people in different areas or whatever." Meanwhile, there's all these Yahoo finance stories about with AI, there's a good chance for a solo trillionaire or solo billionaire, was it? Someone who can create a company using AI, $1 billion company using AI and be a solo employee. So I don't know, I don't know who to believe, but anyway, my takeaway in all of this and what I'm trying to really say is that tariffs are not fully priced in. Again, these thought leaders, no, these CEOs and whatever are using old inventories. They are accepting reduced profit margins for now. And reduced profit margins, we know, are not great for stocks. And again, this is macro look. I get that the market was up big yesterday. But my overall question as I kind of go through this is okay, we have these leaders of companies, and again, this is local Detroit, whatever, so take that for what it's worth. But they're all saying, hey, we are trying to reduce headcount, or we're trying to reduce expenses. But what happens if the job losses accelerate faster than the job growth in other areas? As they all said, hey, it's not our job to train people in other areas, but we need to get rid of the people who are no longer, get rid of the areas of the business that are no longer efficient, and we can use other whatever. So I don't know what ends up
Jeff,
happening.
can I pop in here for a
Yeah,
second?
please.
So first of all, what we can do is we can boil this slide down to two words: yes, but, right?
Right, yeah.
Second is, so what you're really saying is I should be looking for ways to replace you
Yeah,
using artificial intelligence.
100%. I'm not sure actually why you don't have me or have ChatGPT come up with all trade recommendations. I mean, you saw my Apple trade in MTC, so
And the third thing is, and the thing that's not being, it's too early to address, is this creates opportunities for investors and traders in the software services
mhm,
and the education ends of the market because one, the companies that can provide a bridge for artificial intelligence will have a huge leg up. And I will tell everybody that through various parts of our company, we've been looking at ways to leverage AI. We use it very, very small. The daily recap that you get at the end of the day via email is supported by artificial intelligence. So it takes the transcript of Breakfast Club, for example. It pulls out the key points and then puts it into a document, which is then reviewed by Kara, one of our employees, and then she puts it into an email format and then sends it off. So we do have some mechanisms for use of artificial intelligence currently, even in our business.
But the
Um,
difference, if I may, the difference is you're using that to add value and increase something that we were never doing before
mhm.
versus replacing. So I appreciate that part.
But that the second part of that is what happens to the cost of employment. The employment cost index would be fascinating to watch if this starts to take shape, because if, let's say, you eliminate, just for simple numbers, 100 people, well, you're not going to replace them with 100 people. You're going to replace them with maybe 10. So there's a duality here around this problem that I don't think anyone's prepared for. Whether it's on the reduction of the labor force, uh, but the cost benefit to businesses that could be explosive. So we've got to start hunting down software service companies that can fill gaps. But because as we've looked at a large number of artificial intelligence tools, one of my expectations is in the next 1 to 5 years, and probably sooner in the 1 to 2 year category, you're going to start to see um, acquisitions. You're going to see a shrinkage of the companies providing a artificial intelligence in different industries, as we start to get winners and losers. Right, so the winners eat up the losers to grow their businesses further and become the bigger winners. Um, that's a trend that will start to take shape somewhere in the near future. Uh,
I
and
would
and
love to see
I
mergers and acquisitions come back. That would be fun to trade.
Uh, if you There was a story yesterday on Market Watch, I believe, about and this is, his name now escapes me, but the guy who called or basically made the Big Short trade back in
Yeah,
2008.
yeah, Barry or
Um,
whatever.
and yeah, and he's all in on tech, on technology, on AI, bullish on U.S. economy long term, things of that nature. So he had some interesting things to say in and around all of these types of topics, just major shifts, things of that nature. But he sees them as good things and bullish things. So I'm glad you had a chance to attend that, because
Yeah,
it's interesting. I mean, we're just Detroit, right? We're just a little
yeah, yep.
microcosm of the economy, but there are still some important companies in and around the metro area here that I'm fascinated that you had a chance. I'm mad that you had a chance and didn't even invite me. You didn't even call me and ask me to
Uh,
be your date, for crying out
that
loud.
there was a reason, but I'll tell you about that one offline. Anyway, um, I may have had to sneak into this thing. Okay, no, all right, let's keep going. We're already out of time here. So okay, overnight futures, at least as of about 20 minutes ago, they were pointing higher as Fed expects the rate cut in September. So one of the things I wanted to kind of point out here um, was that the market priced in a 96.2% chance of a 25 basis point cut in September. So I believe that in September, if there is a rate cut, since that market is already pricing that in, it's likely going to be a non-event. So the risk then becomes um, to the downside if the market was wrong, and if the rate cut doesn't come in September, and we've already priced in gains based on a 25 basis point cut, which is why, again, market's been going up the last couple of days. That could be a major downside or major risk to the downside if the market was wrong pricing that in. Again, it's one of those things that John always talks about, how the market trades on on the future, not on what is going on right now. So I think we've seen some gains with the idea that a rate cut will happen, but that means when the rate cut does actually happen in September, likely a non-event. And so, one of the reasons for all of this sort of bullishness is that, yes, inflation is on the rise, but it didn't increase as much as some people feared. This is coming from Morgan Stanley. And and so now the Fed is, focused more on preserving the labor market, which is something that John talked about on Monday. So the rest of the economic calendar, we do have a little bit of a break on today. We do get into PPI and core retail sales. Again, the retail sales is one that I am very fascinated with, just especially based on yesterday's conversation or last night's conversation, to see, if consumers will continue to absorb tariff and continue to spend, or if we start seeing a slowdown in that, or certainly we could see a slowdown if companies start reducing their workforce, then we could also see a slowdown in retail sales. And if we're wrong on all that and retail sales continue to go up, then that just means, hey, it's not going to be as bad as maybe some people thought earlier on. So, and that's not a bad thing. I'm apolitical in this. I just want to make money in the market. So, as far as month to date S&P gainer, so this is very easy. Like I like the theme sort of today, where John showed a very simple scan, and it doesn't take much. I'm more of setting up trades, and I'm wrong. I have wrong trades. I have wrong interpretations of charts, but I like setting up trades more in using statistics and probabilities. And if I set up the trade, and if I do enough trades and I get enough reps in, and I follow, losses and setting up the trades the right way, then it doesn't really take much. I don't mind having a 50% win rate. I don't mind having a 30% win rate on some of my scans, as long as the risk to reward is there. My point in all of this is a very simple scan. We're about 10 trading days into August. So I just looked at what over the last 10 days, what are the stocks that are on the move the most? Generac, eBay, Teradyne, Electronic Arts, Palantir, ANET, one that we've been talking about a lot, ANET. So I'm not saying that today is the perfect day to enter into any of these, but these, especially if you're looking for like bull put spreads or whatever, I mean, we see that these stocks are already on the move for the month. And you can fine tune your entries, but really you don't need a wide range of stocks to follow. Your watch list can change every single week just by looking at what are the top performers for for the month, and then just structuring trades around that. But if you're in any one of these, you're not doing too bad this month. So that brings me to one. Now this kind of goes contrary to what I just said, because again, I have a bazillion scans for a billion different reasons. So one of the scans that I have looks at how far away the stock is from its 20-day moving average. That's this green line up here. And how close it is to the 200-day moving average. That is this purple line down here. There's also some other metrics, financial metrics in there. So overall, you can see that the stock has been performing well since April, like the rest of the market. It is pulling back some, and we're now having a doji right above the 200-day moving average. So this particular scan, or this particular setup, and I know some of these bullet put spreads that we do and whatever, we go out to a 15 delta and everything else. This is a little bit more aggressive, saying, hey, the 200-day moving average is right around that $127 mark. We're currently sitting at 128.96, a doji bouncing off the 200-day. I don't know if this is going to go down. I don't know if it's going to go up. Statistically, the scan, has performed well, but the reason that it performs well is we're not doing a 30 delta or 15 delta. We're pretty much going almost right at the money. And so this is $1 wide, and you're getting a 34% return on capital for a 1-week trade. Now, this is not something where you're going to win 90% of the time, because again, you are trading essentially right at the money. So if you look into something like this, what you're really looking for is you need that credit to be higher than what you would normally look at, because you're taking on more risk. You're selling in at the money put. But if you think that Datadog, which has good financials, solid financials behind it. It has had a good run. It's just having a little bit of a pullback, and bouncing off of, or potentially bouncing off that 200-day moving average with a little doji candle. Then this is a potential to make about 34% return on a dollar in 1 week. The other thing you can do, I didn't put all of these out, but you can do like a 127 by 125. I was actually getting 30%, almost down to like a 4 or 5 wide spread. So if you can either, if you like the trade, you can either up the number of contracts, or you can make the spread width a little bit larger. Just make sure you're getting about 30% or more on that one to make it worth it. And again, if this comes back in a week and you say, oh man, I lost, this is not one of those where you win. You're not going to win 90% of the time, but if you hold on to the end, a 30% return, if you win 70% of the time, 80% of the time, you're going to be doing just fine. So anyway, that's my trade idea of the day. I know we're a little bit over. So John, is there anything else you want to go over? I can go to Think or Swim and look at anything if you want, or.
Nope, I think we've got everything lined up for the day. Let's get people out to their trading sessions. Millionaires Trading Club at 11 a.m. Income Masters at 12:30. And Jeff and I will see everyone again next Monday. Uh, what is next Monday? The 18th? It's the 18th, isn't it? Monday, August 18th at
Yes.
8 a.m., 8:30 a.m., excuse me. And reminder, Income Madness Week starts next week. For those of you either part of Income Masters or if you get a ticket separately. So for everyone here at Traders Reserve, thanks very much. Enjoy your trading day. Good luck out there. And we will see you either in a live trading session upcoming or at Breakfast Club next week.